Good morning, everyone. A very warm welcome to everyone this morning. A massive thank you to BetSita for allowing us opportunity to present to you today. We have 274 Capital Partners, which will be presenting on the topic Unlocking Yield, the role of private credits in the retirement fund portfolios. On the panel today, we have Morné Visser, who is the Head of Private Credit, as well as Yumna Peterson and Wim Prinsloo, who are Senior Analysts in 274 Capital Partners.
Morning, everybody, and thank you for the opportunity to share the following 2 hours with you on this webinar and discuss private credit with everybody. As Marlene made the introduction, myself is Morné Visser, the Senior Portfolio Manager and heading up the private credit strategy within 274. And then with me, I have Yumna Peterson and Wim Prinsloo, who's also going to speak on behalf of 274 and the team, who are both senior analysts in our private credit strategy. Just for context, because I believe it's important to know where we're from and what as reference when we speak to you about private credit. So certainly we are very passionate about private credit, and we believe it does have a strong position within the fixed income fraternity. It's a fairly young strategy within the South African market, and that's why we appreciate platforms like this morning, where we can, to a larger audience, really explain what private credit is, how it can benefit allocators or investors, and then also what good results can come from this sort of niche strategy. Like I said, this is a strategy that's finding its feet in South Africa. There's a lot of misinformation about the strategy in South Africa. But I mean, obviously, like I said, this for us is an unbelievable strategy, and we see this as being a critical part of any asset allocation strategy from a allocating and investor point of view. We are we're just going to give you an overview. You all probably know 274 as an investment company. Those are the 4 pillars which make up the company, and we as 274 Capital Partners are in the bottom left, and we are managing these portfolios under the investment manager's license. Obviously, there's a strong compliance oversight from within the business, which is very important, and we'll touch to that. And as you all know, as an asset management company, we are regulated by the FCSA. The next slide is just to give you once again just a view into internally how we structure and position ourselves. We've got within private debt, we've got obviously various products, strategies. And within 274, we focus on 3. The one is the Agrarious one, which I'll speak about now. The other one is the AGES, which is the more conventional private credit, and then the real estate on the right. Those are the 3 core strategies we focus on in the 274 business. And those strategies are basically a combination of and a balance between what's the existing skill set within the business, in the sense of when you look at the Agrarious strategy, which is a agricultural strategy, do we have the skills to actually execute on that strategy? And we'll speak about that later. And then on the demand side, is there demand from the market, from the borrower side, potential borrowers? Are there illiquidity in that market? Are the banks or other financial institutions servicing that market? So we assess that. And then from the investor side, we assess if there's a demand for agricultural exposure in that specific strategy. And that then the combination of those 3 will determine if that is a defined strategy within the house. So you will typically have any asset management or investment team will have various sub-strategies within the private credit. The AGES one is very much non-sector based. That's why we call it conventional. And then the real estate is, once again, we anticipated and we feel there's a need for yield pickup in the real estate that maybe investor could not always get or achieve in the, let's say, on the listed side or in the REITs. And obviously we do that because we have the skills to actually unlock that value within real estate. So those are the three. Typically, from a broader point of view, you can have other that focus on infrastructure. They can focus on which is long dated. They can focus on renewable energy, and so you can go on. But those are the three strategies that we in 374 focus on in the private credit sphere. This is the team. The team is very important, and you'll see as we go through the slides that the team, like in any business, even when we assess a business, the team, the management, and all that is critical for success or not. So what you would like to have in a team is obviously a proven track record. And a proven track record, obviously, through the various cycles, because we go through cycles. We've had 2008. 2008, we had the global sort of banking situation, which we'll talk about now. We had COVID in 2020 when things didn't go that well. 21, 22, and all that, where we had various experiences. So track record within the team is important. Just if you look at the names there, and I'll go through it now. But what's important? What's the key skills that you would need in any private credit team? Would be track record. But then, first one is the ability to assess risk and then to monitor risk. So that goes to your risk management skills. That's probably the most important factor in the team. The second one is the ability for credit analysis and financial modeling. That skill needs to be there. Legal expertise. You'll see there we've got two people there. We've got in our team, we've got Johan and Ketzer, that's on the legal side, because any transaction we do, there's a bilateral loan agreement. And within that agreement, both parties would promise to fulfill certain duties. So that skill is critical. Technology and data. In any business today, we've got Justy there. That's our data and software specialist. Data is getting more and more important. And then obviously operational efficiency. Operational efficiency in private credit is critical because we pride ourselves that we'd be much more efficient than most of the banks. And someone asked for capital. So yeah, that's a critical part. But that's the makeup of any private credit team that would be needed just to enhance that strategy and to unlock the value that the investors would typically need from a private credit strategy. It's very much also an active base. So very much if you want to relate it to private equity, it's active. We assess that once we've made an investment, the monitoring goes on. We don't do investment or do a bilateral loan agreement with a counterpart and then the loan just gets put on the rack and we forget about it. After that, it's active monitoring of the ongoing risk of that loan that we've dispersed to the specific counterpart. We thought we'll just take a little bit back and go to the very basic elements of private credit. And the question is, but what is private credit? Because we get asked a lot, what is private credit? And on the left here, we've listed three things. What private credit is, and the first one, obviously, you can read there is a counterpart. There's not a listed company, but a private company. That means anyone that will contact us or approach us for a loan is not a listed company on the JSE or any other regulated platform. That does not mean it's a small company. It can still be a large company. It's just that it's not listed. That specific loan is not syndicated by investment bank. And the third one, the loan is not provided by a bank, but the loan is provided to that counterpart by another party. Just out of interest, if you take in America today, less than 50% of all loans to corporates are provided by banks. So you can see how that market has grown and how the bank has sort of retracted, and that funding gap have got larger, and the need for liquidity has increased. And obviously, private credit needs to fill that gap, or we feel we need to fill that gap. One can say it also differently. What is private credit? Is just a very much more sophisticated way of someone asking you to borrow him money. In layman's term, or in all day, we all experience it probably, or most of us, is when your uncle or your cousin or your family member or friend come and ask you money, what's your first concern? Your first concern is, is the person going to pay me back? There's no different in private credit. The essence of private credit is, your first question you ask yourself, what's the probability of defaulting? What's the probability of defaulting? And in a case of default, what's the loss given in that default? So it's exactly the same question as if someone is asking you in a personal capacity, please borrow me money, I'm going through a tough period, or please borrow me money because I want to grow my business or expand, or please borrow me money because I've got a great opportunity and I need to purchase some equipment for that. So that's exactly the same question. The first question that comes up is, you've got to assess your risk and say, what's the probability of this person defaulting and not paying me back? And that's the question we ask every day to ourselves, and that's the process we go through in our investment process. And in that risk assessment, and that's why I said the first thing you need in your team is the ability to assess the risk, or risk management, is through various quantitative and qualitative data. We work out what's the probability of that person defaulting. Because and we'll get later that, one of the key aspects of the strategy that we offer the investors is our absolute protection of the capital. So we can't afford, and we don't want to have a default position, because our capital protection is sort of critical in our lives and our highest responsibility. And that's also then in private credit why you'll see on the right hand side you get the various sub lending programs within the strategy, which is direct lending, or you've heard all these suitcase words: mezzanine debt, distressed debt, asset-backed lending, real estate, which is said now, specific finance, and structured credit. Those are all suitcase or smart words just to explain that it's a bilateral loan between two parties. The one thing you hear a lot going forward over this webinar is the asset-backed lending. We are fortunate enough in South Africa, unlike in America or Europe, where it's a bit more advanced, the market, we don't have to, or certainly us as an investment team, we don't have to do non-asset-backed lending. So the asset-backed lending is very important for us because of our focus on or the critical aspect of not losing the capital. So if there's a default and if there's a credit event, we can fall back on the fact that there's assets that back that loan, and then we'll work out, okay, what's our loss given default. So we should realize our capital for our investors. We might lose some from our yield, but our capital will be returned. So that's in essence what private credit is. It's a sophisticated way of just way of borrowing money between a financial institution, which is, in this case, it would be 27.4, and any corporate out there, and we'll get to it later, where typically the corporate could not be serviced by the bank or could not get a satisfactory reply from the bank or the type of loan that he was seeking. And that's the gap we are trying to fill on the private credit side. Just the next slide, Ina. Yeah, this is just to put it in give some visual context about where private credit started. As I said, private credit really took off on the right-hand side in 2008. Most of us, certainly myself, were in the banking industry in 2008. But you can see in America, it started in the 1970s. in the 1980s and 20s, there you can see the bank consolidation. What that just means is your liquidity dry up. Very much that happened in 2008 with Basel III, where banks sort of moved back. I would suggest that in 1980s and 2000, the American market, that's sort of the same thing that happened, because, like I said, there's a very strong loan providers, non-banking loan providers in the American market, much stronger than South Africa. So you can see they've started much earlier with that funding gap between what the banks used to fund and what they're not. 2008, it started in South Africa, but really in 2012, you can say private credit sort of started. I'm lucky enough to have been there. I've seen sort of the born of private credit. In those days, it was very much called shadow banking. So there was no compliance. It was very much really very little private credit in the asset management industry. But that's where the banks started coming in 2011, 2012, 2013. The banks really started retracting with their capital adequacy ratios within the banking sector, putting pressure on them, and they really had to or were forced to really look at where they have exposures on their balance sheet, which sectors were overexposed, or which sectors the perceived risk was too high for the balance sheets and all that. And that retraction basically provided the funding gap I always speak about, and that's where private credit came in. But the important thing about private credit and where we are today, it's definitely not shadow banking. If you look at the compliance, if you look at the experience of the teams, of all our competitors out there, it's very much a internally regulated, sort of defined strategy. And we've really taken everything we've learned in the banks, the ability to assess the risk, to provide a loan, and then to be repaid. And that whole process we've refined outside of the bank, and we can provide facility to the private market out there, just as if we are a bank. And that's why you see the growth in the industry, especially worldwide and then South Africa. Just the next slide, Yilma. Yeah, this is just a word summary of what I've said. It's a very big market, 2.5 trillion by 2030. I was fortunate enough to be hosted by an American company about 6 months ago that visited South Africa, and them alone were only managing private debt. That's the only product they have, and they had $495 billion under management. And obviously they've got offices across the world. That's just one company, so it's really big. And then in South Africa, that it's a guesstimate that we are around 30 billion, and that can also be the various strategy. It can be real estate, it can be infrastructure. Infrastructure in South Africa is very large with the renewable energy programs that we've been running, all that. But we're looking at 30 billion. Hopefully that can grow, and we'll speak about that also going forward in the slides. Yeah, just before I hand over to Yumna, our senior analyst, there's some things that you might mention that might sound repetitive, but private credit is very simple strategy, but it's obviously not an easy strategy. But the simplicity comes in. There's certain things that you must adhere to as an investment team. There's certain rules when it comes to debt as a product that you must adhere to, and should you adhere to that, and if you fulfill your duties as per what the requirements of the strategy is, you should not run into unnecessary problems, and you should run a very good, clean yield enhancement portfolio. Yumna, I'm handing it over to you now.
Okay, thanks everyone. Good morning, Marlene, analysts and viewers. So I'm going to talk a little bit about this next slide, global growth drivers of private credit. So from a private credit perspective, we've identified that private credit is experiencing unprecedented global growth. And this slide captures the 5 core drivers behind that momentum. So I'd like to explore what each of these pillars means for the market and for the investors. So capital demand and supply imbalance. This first pillar highlights the persistent gap between the credit needs of businesses and the capacity of traditional banks to meet those needs. So as banks step back from certain segments, especially the mid-size and riskier firms, private credit providers now, as mentioned by Moine, are then stepping in to fill that void. So this dynamic isn't just about more demand, it's about a fundamental shift in who is able to access the capital and under what terms. Then next, we look at bank retrenchment and regulation. This, I'd say, is of critical importance and was highlighted previously as well. So here we see how regulatory changes and increased scrutiny has made banks more cautious, particularly after the global financial crisis. So in that aftermath, regulatory reforms such as Basel III and more recently Basel IV have significantly tightened capital and liquidity requirements for banks. So as a result of that, these regulations now require the banks to hold more capital against riskier loans, making the lending to non-traditional or the higher risk borrowers more expensive and also less attractive. So when we speak about Basel III and Basel IV, the major difference there is, or I'd say the difference is that the risk-weighted asset percentage is the only major difference between the regulations. So from a Basel IV perspective, that was rolled out in, I'd say, 2023, and supposed to start implementation in the major jurisdictions July 2025. So here, banks is now where Basel III introduced these strict capital requirements. Basel IV has added another layer to that, where banks will face stricter limits on how they specifically calculate the risk-weighted assets. So in Basel III and Basel IV, the tier 1 and tier 2, those ratios remain the same. However, the way they calculate the risk-weighted assets, that's where things has changed. So with Basel IV in particular, it introduces the output floor. And this output floor limits banks' ability to use their own internal risk models, which can be used to lower capital charges. So this change especially impacts sectors like your real estate, unrated corporate borrowers, and which often carries higher risk weightings. So consequently, as a result of that, banks is becoming more selective and reducing the exposure to these type of segments. So with this regulatory tightening, it has led to a contraction in the traditional bank lending, and again creating that financing gap that we speak about. So from private credit funds perspective, they are now stepping in, or we are now stepping in again to fill that void. So where we can provide flexible and tailored lending solutions that banks is now less willing to offer because of this tight regulatory environment they find themselves in. So this shift is a key factor in driving the growth of private credit globally. Then on the investor side, we look at investor demand for yield and diversification. So from investor side perspective, there's obviously a strong appetite for higher yields and portfolio diversification, especially where they may be earning lower interest rates on public debt instruments. Private credit, on the other hand, now offers institutional investors a way to access attractive returns with less correlation to the traditional asset classes. And in this way, it can help smooth out, these asset allocators or investment allocators' overall portfolio performance. Then if we move on to declining cost of capital for private credit funds, this is another key factor that private credit has become more cost competitive. The the gap, I'd say, between the cost of capital for banks and private credit vehicles has narrowed significantly over, the past decade, I'd say. This in turn then means that private credit can offer more attractive terms to your borrowers and then further strengthening their position in the market. And then finally, structural and macroeconomic factors. Here, the broader structural and macroeconomic trends are at play. There's a shift from your bank lending to non-bank lenders, driven by businesses' desire for flexible and tailored financing solutions. And we can see that this trend has intensified during periods of economic stress, such as the aftermath of COVID-19. Which makes private credit increasingly important part of the financial system. So if we look at all of these together, these 5 pillars they don't just explain the growth of private credit, but they also show us why the shift is likely to be longer lasting. It reflects changes in regulations, investor behavior, your funding costs, and also, more importantly, the evolving needs of these businesses, and all of which I would say is reshaping the global credit landscape. Then I'm going to hand over to Wim.
Thank you, Yumna. Good morning to everyone. Yumna just spoke about the global context, but let's take a closer look at the key factors that are driving the growth of private credit, specifically in the local South African context. So the first factor relates to the global financial crisis of 2008, which Mornay briefly spoke about. And many see this crisis as the catalyst for the growth of private credit as an asset class. The fallout from the crisis led to significantly stricter banking regulations, which impacted the banking sector's ability to lend to the SME market. And this is the so-called funding gap, which is referred to as the so-called funding gap, and is now being filled by private credit managers such as ourselves. The second factor locally is regulatory reform. So updates to Regulation 28 now allow pension funds to allocate more capital to private credit, making it more accessible to investors who want to diversify into private markets. Thirdly, private credit providers can offer tailored funding solutions to the SME market to meet its unique needs. We find that banks are often unable to provide such tailored solutions to the market. The fourth factor is it's obvious it's the higher returns, the yield pickup. So compared to traditional fixed income or listed bond markets, private credit typically offers higher yields and provides diversification benefits. This is due to the fact that private credit returns are often uncorrelated with those returns in the listed market. The fifth point refers to fintech. So the growth of technologies such as artificial intelligence or AI is playing a major role in allowing private credit providers to streamline their processes and the ability to quickly quantify risk. This is making private credit more efficient, accessible, and scalable. And then lastly, what we're seeing are synergies with the private equity market. So we've noticed that private equity managers use credit as a complementary tool to create additional value to their deals or their funds. This provides us with the opportunity to us as the private credit manager, with the opportunity to participate in a wider range of deals, and with the benefit to the client that or the investor that due diligence is performed both on the equity side from the private equity manager and then on the private credit side. Thank you. Can we move on?
Okay. So having explored the global and the South African forces driving private credit, let's now focus on private credit's key characteristics. What specifically makes private credit so compelling for both the investors and the borrowers globally and in South Africa? So we've broken that down into 4 areas. So if I look at customization and flexibility, here we focus on the borrower. So one of the biggest differentiators, I would say, of private credit is the ability to offer a bespoke financing solution. So unlike traditional banks, private credit providers, they can move quickly. They can negotiate terms that fit the borrower's unique circumstances and support growth, even in sectors or regions that may be overlooked by your mainstream lenders. So this agility is particularly valuable in a South African setting where many mid-sized businesses and SMEs face these funding gaps as the banks are now, because of your Basel 3s and your Basel 4s, are becoming more risk averse and constrained by these regulations. Then we look at risk management. Here, the focus is more from an investor perspective. So for investors, private credit brings that disciplined approach, I'd say, in terms of managing their risk. So with the private lenders adopting, this rigorous due diligence processes, ongoing monitoring, and using collateral and covenants, investors is able to preserve their capital and obviously, coupled with that, protect against downside risk. And this is increasingly important in today's volatile environment, both when we speak about it globally and locally, where market shocks and economic uncertainty is on top of mind for institutional allocators. Then we move on and we look at attractive returns. Here again, we look at it from the investor perspective. Private credit stands out for this. They stand out for the fact that there's a potential to deliver higher yields and more predictable cash flows compared to your traditional fixed income. So in South Africa, this is especially relevant because investors are seeking alternatives that can provide, stable risk-adjusted returns, as well as diversification benefits. And this is, obviously the opportunity has opened up here because with the recent regulatory changes where it allows pension funds to allocate more to private markets. And then lastly, positive economic impact. So beyond financial returns, private credit plays a vital role in supporting economic development. So, by providing liquidity to underserved markets, private credit, in a sense, can help fuel business expansion. And through that, job creation and ultimately broader economic growth. So in a South African context, private credit translates into real opportunities for your impact enabling SMEs to assist them to scale and to help to drive transformation across the economy. So as we see in the slide, private credit appeal lies in its ability to deliver that tailored solutions for borrowers, the robust risk management and attractive returns for your investors, and then ultimately a positive economic impact. So in our view, these characteristics is driving the rapid adoption of private credit around the world and is just as relevant, if not more, in South Africa as the market continues and continues to mature and to expand. I just want to move on to the next slide. Okay, so here I want to have a look at the private credit landscape. So this slide gives us a clear overview of the private credit universe and how it differs from your traditional lending and public debt markets. So on the right-hand side of the slide, there's a visual hierarchy showing how different types of debt rank in terms of repayment priority. So senior secured debt sits on the top, meaning it is repaid first in the event of default, which is why it carries the lowest risk and return. So as you move down the capital stack, you look at secured, unsecured, and subordinated debt, each with decreasing priority for repayment and increasing risk, but also the potential again for higher yields. So then we look at, we move to the left, and then you'll notice a spectrum that maps out various types of private credit investments by both the potential returns and the risk levels. So at the lower end, we see instruments like infrastructure and real estate debt, and where they tend to offer more stable, predictable returns, whilst carrying relatively moderate risk. And then you move a little bit up, and then you see senior direct lending and unitranche loans, where they provide a balance between your risk and your reward, making them a popular choice for institutional investors seeking, that steady income. So as we shift further to the right, the risk profile increases with products like your mezzanine, syndicated mezz, subordinated debt. These instruments sit lower in the capital stack, but they offer potential higher returns, but also come with greater exposure to losses in the event that a borrower defaults. Then we go further up at the top end. We look at equity-linked instruments such as co-investments and warrants that provide highest return potential, but with the risk levels that approach those of equity investments. So what's important to take away here is that private credit offers a broad set of tools for both your investors and for your borrowers, where investors can choose from a range of risk return profiles to suit their specific objectives. While the borrowers benefit from, having a facility or financing solution that is more tailored to their specific needs, and which isn't necessarily available in your public market. So this flexibility, I find, and the ability to customize terms is a major reason why private credit continues to grow rapidly. Ultimately, the landscape allows for more creative structuring, better alignment between your lenders and your borrowers, and the potential for attractive risk-adjusted returns, especially, and I think this is very important, especially when it's being managed by an experienced credit professional or team of professionals that understands the market and is able to navigate, through the spectrum. Let me hand that over now to Mone.
Thank you, Yumna. Thank you, Evan, for that. I'm going to use the next 3 slides just to go a bit more granular, more on a portfolio management level, and give you the nuances and the differences when we benchmark on various options when it comes into the credit market. And the first one is the slide in front of you, where I want to use the slide just to explain how you can create alpha. A lot of times when we speak to audiences like yourself or like this, we use the listed capital market as sort of a reference or as a benchmark for the added value that private credit can bring to the investor. We are fortunate enough, myself and the rest of the team, that has managed for many years public credit also. So we understand the market really well, and we've decided that we only want to focus on private credit because we believe that's the future, and we believe that provides the alpha which are not provided in the public credit market. So I want to say that this is not about bashing or being negative about the public credit market. It's just to use it as reference, given our own experience and understanding of that market, and our true belief that for the same risk, little bit more effort, which I'll explain now, we can create that alpha to the investor, which we believe the investor should be compensated for. So please excuse me if it comes across as public credit in South Africa is a bit of a dark show or what. That's not the intention. The intention is just to use it as reference, giving real experiences we have. So just in summary, what you've heard from us now, what we're trying to emphasize here is the nuances or the key ingredients of creating this alpha. And then you'll see that in the next slide too, that we'll present. So on the left at the top, you have an asset class that's niche, that's uncorrelated, where you can get real diversification. You've got information hedge, which very much goes to information arbitrage at the bottom, and this will all come through now. And you've got, obviously, if all successful, you've got a yield pickup. So that's sort of the ecosystem that's available to us, because we spoke about the lending gap, where the banks used to be, where they're not. We spoke about all the factors driving private credit. But at the end of the day, in its essence, you've got a market which is companies, corporates, that needs liquidity to grow, to expand, to get their liquidity within their own capital structure, right? They need capital for positive reasons. And we believe, or we can see, that they are underserved from time to time, and that's where we want to step in. So that the opportunity is there. I think we've established that, and we've laid it out to that. So all we are saying in this team, or what we're presenting to you today, if we all believe the opportunity is there and it's real, what do you need to actually make a success of that, and why can you make a success of that? And that's what we're trying to do here. And like we first said, the first thing, you've got to have an investment team that really understands the asset class. It's like, I think I've mentioned it before, it's a very simple asset class, but it's definitely not an easy asset class. So your team experience, and that's why you saw all those names and beautiful faces when we started, is critical in this, and how they support each other in the various segments of the investment process. Like I said, the legal understanding, the understanding of pricing, the understanding of risk. We take a lot of data, we take past data, and then we forecast it forward. And through that data and the interpretation of that data, we need to come to a very clear understanding that the probability of default in this case is at such that we should not be alarmed, and we can go ahead with agreement with the counterpart. So that team aspect, an ability to understand the market, to understand debt as an instrument, to understand the philosophy of what is debt and what it's not. That understanding and deep understanding, we always speak about going narrow and all that, deep and narrow, that's critical. If you don't have a team, I suppose that's with any strategy. So, but because we've worked in the public side and now on the private side for the last 10 years, we want to re-emphasize that alpha doesn't just fall on your lap. If you do not know what you are doing as a team, and you don't supplement and complement each other, you will struggle to enhance your returns or to create that alpha that we speak about. So team and experience is critical. Then origination, we always mention origination because it's such a It's a topic that seldom comes up when it comes to investment process or investment philosophy when it comes to private credit. But it's critical, because you can imagine now, we're not, as a team, just like us as a team, as an example, if we originate potentially weak transactions, that's just going to make us inefficient. Because why do you originate weak or fundamentally weak transactions? Is because your ability to assess the perceived risk right at the beginning is not good enough. So what you're going to do is you're just going to feed potentially bad or fundamentally weak transactions into your investment process. We haven't spoken a lot about our investment process and philosophies because we don't always have time to do that. But we've got a very, very specific investment process. And if that process is not working like clockways, then we are not going to have the ability to provide a good service to the market out there. So the ability to originate is critical. How do you originate well? You originate well is when people bring you transactions or potential transactions because they believe you as a team or as a product house really understand the market. You can really connect with the potential borrower. You understand his business. Your decision making is efficient. Your process is efficient. Because once again, on a very granular level, if we get in front of to a mid-sized corporate out there today in the market as a portfolio manager, you can see, you get introduced to that company. The first thing I always ask the CEO, the financial director, I said, how long? Because it's just normal. How long have you spoken to your bank about this application? And true, the answer is always 6 months, 1 year, a year and a half. And you get that frustration from that company, that specific company. It's just that the bank couldn't serve them. So we've got one needs to be careful when we say it, but I can say this, we can see what's happening from our side of the business. So we see the banks really at the top end with the larger, competing there for multi-income streams there with the larger companies, or they're at the bottom here with the cell phones and the bots and all that and the smart stuff. But right in the middle, in South Africa, in the market that we experience, there's a great underserved mid-corporate segment with great balance sheets, prudent balance sheets, very good executive teams, and long track records where we get exposed to. And those are the companies that approach us, and we need to ensure that all those companies, the good companies that needs that liquidity, approach us as a team. So that's why origination is so important. For us there's a lot of transactions out there, but for us or for anyone else, you've got to be busy with a good transaction. A good transaction is a transaction that's fundamentally sound, where you're going to lend money to the borrower and the borrower should pay you back and all that. Information arbitrage, that comes back to the next slide. We will speak about that a bit. We are fortunate as private credit that the information we see from these counterparts or potential counterparts, when we start interacting with them, that information is not publicly available. So we're not really competing. It's a bit selfish, or it's a bit sort of for enhancement from the investor side that gives us a heads up there. That information, we can sit with that information. We can really assess it without knowing that everybody's looking at the same thing, and we are sort of in the run to the end and competing with other private credit competitors or private credit portfolio managers. Yes, as the market from 10 years back to where we are now, yes, typically you would compete on transactions, but not in the level where it should be. But obviously, as we start competing more and more, that will be obviously to the favor of the borrower. Then just on the structuring side, both Yumna and Wim has touched on it. We've got the great ability here to, with one transaction in front of you, you can structure that transaction the way you want to. You can mitigate your risk the way you want to. Your downside protection, make sure that the covenants are right and the covenants are relevant. And then you see there's a small word, define exit. That's just a philosophy or a principle in debt. You never do a transaction in a bilateral loan you never do a transaction without a defined exit. So those those things, you as a team, you as a underwriting team or investment team, you can ensure that those things are in place. And that should give the protection, not just to yourself, but to, most importantly, your investors. You determine that. And if you really understand how to mitigate your risk, that's one hell of a positive for any investor out there. And then also that structuring, we always speak about the spirit of it. The spirit is still, it's the spirit of the transaction is that it's between the borrower and the lender. We're not speaking down. We're trying to enhance their business. It's not a stick approach. We define the whole transaction. We make it bespoke to them, and we make sure that we can do anything we can for them to realize that defined exit. The second one, which is important, and that comes back to the return aspect, and you also alluded to that, is the pricing. And that also, when we get to the next slide, you will understand why I'm saying pricing. The pricing is as such, there's no index. We can determine the pricing. We determine the pricing of the risk that we see in each transaction in private credit. Yes, we understand you need to be, it needs to make sense. It needs to be prudent. It needs to be related to something, to either to prime or to 3 months JIBOR, and the fact that the borrower can actually afford that pricing structure that we recommend. But the biggest thing for us, and then for a potential investor, is that we determine the price of that loan. It's not determined by an index or something out of there, and then it's for the borrower to really understand why we're pricing the risk or his company's risk at that. So those are the four, or the various aspects to derive, should you want to derive alpha out of credit. Is you've got to have a great team. You've got to have the ability to originate the best transactions out there, competing with the other managers or competing among managers and with the banks, because you're competing with them. Yes, you have the advantage that you have information arbitrage, which you should utilize. Structuring, you structure the risk out of that transaction to the best of your ability to define your exit, and then the pricing, you determine the price. And you'll see in the next slide, in the capital markets, you've got no say in your pricing. You either accept the pricing or not, and you go into a Dutch auction. So that's the combination, how we feel you create alpha in the private credit market. This comes very much to what I said before I started these 3 slides. We are fortunate. I'm fortunate to have managed large public credit portfolios, and now we focus on private credit. And one, just a highlight for those that are not familiar with public credit. Public credit, there's the supply and demand. There's a big imbalance due to limited issuance. We don't have, if you take out the SOEs, there's not a massive amount of issuances, and we have the figures and we follow and we track those figures. There's not a hell of a lot of issuances in the market, or if you look at the size of our economy, there should be much more issuances when it comes to public credit or issuances. There's not. It's mainly your REITs and various corporates that we all know by name, and that makes so there's limited issuance, but obviously you've got a lot of cash looking for that issuance, and then you get this margin squeeze, and then because of the margin squeeze and because of the imbalance, we believe the investors don't really get compensated for the risk that they are taking on that issuance. And that's why we speak at the bottom, we speak about that disconnect. If you look at the pricing of some of these issuances, you say, well, it can't be. This is absolutely doesn't relate. The pricing doesn't make sense. This is as if it's in an economy, in a country, in a continent, in a world where everything is perfect. It doesn't make sense. So, and that's for if you're a portfolio manager, that's a challenge to get over that. Typically, then, I said about concentration risk, but what I want to speak about is the influence, investor influence, and then the pricing. Because I spoke most of the others, in the investor influence is very low. That means myself as a portfolio manager getting approached by one of the leading banks as the lead advisor on the issuance. They will present you the issuance, the detail of the issuance, the duration, the returns, or they provide you a price guidance, the specific covenants. You don't have any. If you remember my previous slide, you are only taking information, and you've got no influence on that information about the core sort of characteristics of that specific loan. You've got no say into that. So you basically are a price taker, as we call it, in that. So the investor influence is low to zero. You can't put in a covenant that you would think is missing. You can't recommend it. Any mitigating strategy that you thought about that would have been good to add to that transaction, you've got no influence in that. So basically, get asked to go to the do your risk assessment of that issuance, and then to go to a Dutch auction, there's some price guidance on that. But I mean, that's not a great feeling as a portfolio manager, I would say. Then if you look on the right hand side in the highlighted area, that's everything that's private market. Is not, and it relates to the previous slide I said. We determine how many transactions we do given our efficiency per year. That's why efficiency is so important. We can do 2 transactions a month, we can do 1, we can do 5. It all depends on our automating that we bring into our processes, our investment process. We've got, just as summary, we've got origination, underwriting, investment committee, the implementation where the legals comes in. Then we've got the monitoring, and then we've got reporting. That is basically the core of our investment process. If that is working well, we can do a lot of transactions per year in that market. So we determine the pool or the supply side when it comes to our own strategy. We spoke about it, the investor influence. Our investor influence is extremely high. We determine the pricing, the structuring, what covenants we need to put in, and all that. The price, we determine the price. I'm not going to go over that again. We decide, given our own internal risk assessment models, what the price is. We speak to the potential borrower about that pricing, and if he's in agreement, then we go ahead. But it's not a benchmark somewhere else, and the price is determined by someone, and you've got no influence on that price. If the pricing is not right, we stop the transaction there, or we stop the process there. And usually, like you would probably don't know, but just for those who don't know, that's why even when it comes to origination and it goes to a pre-screen, which is under underwriting, we typically discuss the transaction, look at the perceived risk, look at the real risk, and then we'll do a term sheet. The term sheet is there. It highlights the key characteristics of that transaction, how we see it. And then we share that with the potential borrower. And there it would be stuff like the pricing, the duration, the security, and the covenants. Those are sort of the highlights, and then other issues too. But that highlights, and that's where the borrower can see, okay, well, I think I've got a good probability, or I can see these people understand the transaction. I can see the pricing is something that can work for us. The covenants, I'm happy with that because it reflects our own internal covenants and things like that. And once that is signed, we obviously then go through with the transaction, and hopefully it gets approved by our independent investment committee. We've got independent people, and then gets implemented. But that pricing issue and the covenants has been dealt with them before. Although I must say, even in that, just from a sort of a practical point of view, even when we do the bilateral loan agreements, there's always a bit of arm wrestling about the key issues on the transaction itself. But usually, if you look at the spirit of the transaction between the two parties, because we focus a lot on that, that should not be a bit of arm wrestling, but usually it works out positively. Just the next slide. So I just wanted to benchmark the difference between, in our world, we see public credit we see it as a beta, and then private credit, where we take the same product, where we create the alpha in credit, and we just call it private credit because we as a team or any portfolio manager and his team out there, they determine the outcome of that product much better. This is just a visual. This is nothing smart. This is just a visual to illustrate the alpha. And there's many data that can show you the gap between public same rated, and that's why we call it risk-adjusted returns. We take some of those public counters through the same risk models than our private counters. They both come to the same rating. For the one, we're getting 3-month Java plus 600, and for the same rating in the public market, unfortunately, well, it's obviously good for the financial director and the CEO of that issuance company. I mean, they must be smiling, and good for them, because they're getting capital at very attractive rates. But there you can see same rating, everything the same. We can outperform or get enhancement of 500. Yes, and that's why I said on the right hand side, that doesn't fall on your lap. You still, that active management, you can just, by explaining or quickly mentioning our investment process, is very intense, because we can't afford to make mistakes. We can't afford to lose capital to any of our investors. We've got to have defined exit. We've got to have good bilateral loan agreements, solid if something happens. We've got to monitor all that. That takes a lot of resources and effort. But for that, we get the 500, and we are happy to do that. So that's a sort of the trade-off between the two. I always joke, you can sit behind your computer and wait for an investment bank to call you, and you can manage public credit. And once again, I'm not bashing private credit. It's just that I've been there, I've experienced myself. You can wait there, you can play golf or whatever you want to do, and you'll get your Java plus 100. Or you can work very hard, and you'll get your Java plus 600. And that's, in essence, or in layman's terms, that's how I always joke about it, but that's the truth, and that gives us, obviously, a great satisfaction. And that's why and that probably depends on your personality, and that's the return for us as a team too. That very hard work on the right-hand side there, the structuring, the monitoring and all that, but a satisfaction of really getting a return for your risk you are taking up, a true return, and sometimes a bit more, versus on the left for the same on the public side. Yeah, that's a bit of a wrap on a bit more granular about how we experience it, how we experience the market, and obviously, hopefully, in the question side, we can elaborate on some of the key issues we highlighted. I'm just going to ask them to quickly, from a presentation point of view, talk to us about some returns in a more formal way. I've illustrated to you those outperformance on credit and what it takes to get that outperformance. But I mean, and Wim will explain to you, unfortunately, in South Africa, we don't have those that many years back with the indexes and so forth. But yeah, Wim, I'm not going to steal your thunder. You can go for it. Thank you.
Thank you, Morné. So this slide summarizes some of the global findings. When looking at private credit performance data, and we're looking at the US and Europe markets, which are the two biggest and most developed markets in terms of private credit. And then on the last slide, we'll compare private credit in the US and Europe against listed credit in those two markets. So the key insight, and then I mean it's been touched on in this presentation, that over the last decade, private credit has delivered superior risk-adjusted returns relative to your more traditional fixed income strategies. But what I really want to emphasize here are the three key structural advantages that we believe are driving this outperformance of private credit. So firstly, and it's been touched on by Morné, private credit providers or lenders have the ability to hold senior secured positions. What it means is that our loans are all backed by tangible assets that can be claimed and perfected if the borrower defaults. And ultimately, it provides strong downside protection to investor capital. Secondly, we've got the ability as private credit providers to have floating rates on our deals, which means that in a rising interest rate environment, which often occurs due to higher inflation, that the interest rates on your private credit transaction can be adjusted upward which helps to preserve capital in real or after inflation terms. And the third factor is tighter covenants. Because our offering is a bit more bespoke than a bank's offering, private credit agreements often include more stringent financial covenants compared to those in the public market. And it allows us, from a financial health perspective and a monitoring perspective, to intervene early if a borrower's financial health begins to deteriorate. Yumna, next slide, please. Yeah, so now we're going to look at some of the data. So again, back to this is US and European data. And on the left-hand table, we're looking at absolute returns in hard currency, in dollar terms. So over the past decade, US private credit has delivered returns in the range of 8 to 9% per annum. And European private credit has actually outperformed the US with returns of 9 to 10%. So we've seen that credit spreads in Europe are typically still higher than those in the US. But as a whole, both the US and European private credit markets have outperformed listed credit, which is represented on the table by US high-yield bonds and US leveraged loans, which have provided returns or annualized returns ranging from, let's say, 4 to 7%. Then the table on the right paints the same positive picture when we're looking at risk-adjusted returns, or the Sharpe ratio, and then volatility as well. So both the US and European private credit markets have higher Sharpe ratios and are less volatile compared to the US listed credit markets that we've shown there. So in summary, looking at the data over the last decade in Europe and the US, private credit has outperformed listed credit both on an absolute return basis, but also on a risk-adjusted basis. And we really believe that much of this outperformance can be attributed to those three structural features that we discussed in the previous slide, that are so intrinsic to private credit as an asset class. Mornate, you want to end off with one or two concluding remarks?
No, thank you, Van. No, fine. Hopefully, I can't see the sort of questions, but like anything else, and it's terrible just to speak. In a sense, it would be lovely if we have nice questions, and we are happy to answer them, because I think that will give even more context to what private credit is and how it can be utilized in the pension fund market, or any allocation for that matter, to get that sort of return that you would expect from your risk in that specific market. And yeah, so very happy to go over to the question and answer side and see if there's some interesting questions from the audience.
Awesome. Thank you so much. Massive thank you, Mornay, Wim, and Yumna, for a very informative presentation. The audience have been very engaging, so I hope the three of you are very prepared for a few questions coming up. Again, audience, you're welcome to post any questions on the Q&A tab, as well as the webinar chat, and then we'll get to them. All right, so first question is, who regulates the private equity extenders? Is it the FSCA or the SARB via the Prudential Authority?
I can't speak for the private equity, but on the private credit, it's definitely the FSCA through, as an asset management and financial services company. That's our point of regulation, and obviously we've got strong compliance oversight internally. So yeah, in short, that is the answer.
Awesome.
But just if I can just expand on that, because it might help, because we spoke a lot about the banks. So we do have an advantage, but in the fact that we are not under the Banking Act. So we don't have Basel III, we don't have Basel IV that's coming up. We don't have those stringent requirements that's put on the banking sector's balance sheet, and making sure that they are not overexposed to unnecessary risk for their depositors and all. We don't have that, but we do. But that adds to certainly to myself and to the rest of the team and 27.4 that make us just more responsible to protect the capital, to take the responsibility upon ourselves through our investment philosophy and our processes to ensure that we operate in our own regulatory environment and ensure that we protect our investors and ensure that we do what we say and follow the rules as they should be. Because, like I said, 20 years ago, there was a massive shadow banking aspect in South Africa. And it's a technical word, but what I'm saying is that was not regulated to me. It was business to business loans, business to retail loans. That was not as regulated as the private credit industry is today. Ourselves and our competitors, because we speak to each other and we experience each other, operate within a highly regulated / compliant environment.
Awesome, thank you. So next question, with regards to clients, do you go out in the market to look for them, or do they come to you?
Clients, I would say, can we say the borrowers, potential borrowers? A very good question. Good question. Because you remember, I mentioned that as a key attribute to being successful as a portfolio manager or team or not, because I've experienced it once again, given my age, I've experienced this before many times. It's a combination of that. It's like any business. I spoke yesterday to someone, distribution is key for success in any, if not most businesses. The same applied to us as an investment team. It's a combination of people knowing that we are very good at what we're doing, so they can bring us potential borrowers to us, knowing that we will look after those borrowers, that we'll be professional with those borrowers, that we will not take those borrowers, in layman's terms, down a road, kick the can, and just frustrate those potential borrowers wanting liquidity on a project or growth for their own company, take them through a path that's just as frustrated as the banks. Because remember now, the banks are not bad. The bank are just sometimes, I'm trying to be nice here, struggling to listen to everybody at the same time and service them. That's the problem with the banks. I'm talking about corporate level now. And we can't do the same. And we also bring it back to pricing. We, as private credit, cannot ask for a 200 basis points premium if we deliver bad service. Now, bad service means a lot of things. Bad service means you don't really understand your product, so your covenants are wrong. Your covenants are not related. Your pricing is totally wrong. Your decision-making is not efficient. Your communication back to the client and your reasons for certain things are not at the level it should be. So the experience that mid-corporate or SME is having with you as investment team doesn't justify the 200, 300, and sometimes 400 basis point premium we are asking from the bank. So we take it very seriously in the fact that we've got to deliver a product out there to the market, to as many people as possible that can potentially bring us transactions for them to wanting to bring those to transactions. Because you don't, if you a originator, independent originator, or you are given, or you get to a company that needs capital, serious capital, and it's underserved by its bank, you don't want to introduce that borrower. I mean, it's hard enough in a world, but in South Africa to be successful in business, it's a hard job. And now being frustrated by some investment team that said they can borrow you 50 million for expansion, and it takes them 2 years to actually approve that transaction, or 1 year. I'm getting a bit scope creep there in my answer, but I mean, that's how serious we take it, the origination. So the origination, to come back to your question, it's very important, and we spend a lot of time that we attract the best transactions out of there. People come to us, and through our own networks, people phone us, or we phone them from time to time, ask if they've got transactions for us. But yeah, we've never sat, we call it a pipeline. We build up a pipeline and we manage it actively. There's never been, in 12 years that I've managed private credit, I've never asked where's the next transaction, which is selfish, and which is very good if you're an investor behind us and you want to allocate money to us. But it's obviously not nice or good for the market out there because we are not as big as the banks. We can't lend to everybody. We're just too small. We don't have that scale. But it's great for the investor at the back end because we can really, they call it's a manager's pick market overseas, or where the manager, which is us, we can really pick the best transactions out there. And to take it lastly, and then I'm finished, is it's a stat we keep. So we say out of 10 transactions, we say no to about 9 or 8, unfortunately. Sometimes it's because we are overweight in that sector. Sometimes it's because of duration. Sometimes it's pricing. Sometimes transactions too small, too big. But we really pick the best ones we believe we want to give our investors exposure to, which is not the case in America or Europe, where it's much more competitive. But luckily for us, the private credit market is getting competitive or becoming competitive, but not at a place where we really have to chase transactions, lower our pricing and all that.
Awesome, thank you. Next question. In the South African context, what sectors are most actively using private credit and why?
I'll go away from sectors, if I may, because we've really seen this over the last years. We call it the mid-corporate sector. So within that, it can be logistics, it can be information, it can be fintechs, because I don't want to go too deep, but remember also there's a strategy where we do wholesale funding, where we will provide a large wholesale loan to a existing fintech where we believe their processes, their current book and all that is at the level where we really think they're doing a great job, and then we'll scale that business with their money already in it. So I wouldn't say sectors, I would say size. It's the mid-corporate side. So I would say it's EBITDA 5 million to 80 million EBITDA. That's sort of the slug that we can see that where companies in South Africa are struggling to get the attention of the right people within the banks. And us knowing where the right people sits either at the top in the sense of size, where they do cross-selling and all that on the larger companies, or at the bottom, I call it the bot market, where you speak to a bot on your cell phone.
Awesome.
We are also, sorry, just lastly, we try to be agnostic when it comes to sector. But obviously some of our clients really don't want to say invest into coal. When you have an agricultural strategy, obviously you can't go over to non-related agricultural transactions, but so we try to do the private credit as sector agnostic.
Thanks, Morné. Next question is, given South Africa's regulatory environment, how can it evolve to either support or hinder private credit expansion?
Some of my colleagues can also, I don't want to answer all the questions. I don't mind, but I can just, I can just start by saying board notice 19 Reg 28 is obviously key in our worlds, but you can go.
Yeah, so this is as a private credit division or strategy, we try and align our reporting standards with that of the global frameworks. So in that way, it makes it easier, and it also assists in boosting investor confidence. So in terms of from a bank's perspective, with Basel III and Basel IV that I've mentioned before, there's been a shift towards stricter capital holding requirements. So in that way, as I mentioned, it creates that gap for us for private credit to evolve. If that answers your question.
Awesome, it does. So I want to say almost a follow-on, it does relate to it, but do you take into consideration BEE when considering applications?
So if I can answer that as well. yes, we do. However, each transaction we assess based on its specific merits, regardless of bearing BE in mind. Um, in addition to that, we have specific mandates, and each allocator would have specific requirements, and their requirement may be sector specific, and or specifically mention, BE requirements. So we look at it in different areas, whilst keeping, BE as a consideration. But to circle back to the main point is that I'd like to make is that we consider each transaction on its own merit, and we determine whether or not it fits into a specific investor mandate, and whether it fits into our basic investment criteria.
Marlene, if I can just add to that or re-emphasize what Yumna said, the relationship between the investment team and the investor is critical. So I'm saying that BE is a regulatory requirement for the country. So I believe if any company is not at the level of BE, it should not operate at the level where it would be prudent for us to probably lend to that company. So that regulatory framework is there, and BE is important. But above that, many of our investors have impact requirements, women, social impact, anything like that. And then we have that conversation with them, because remember, we know the landscape and we know what allocations we can do, because we see all the transactions. So the requirements of the investor is critical. And we've got, like Yumna said, some investors would like us to have an average duration of 12 months on our portfolio, or because they're scared of liquidity. Then we address it. Then we go into shorter dated opportunities. Some investors, like now, have a requirement for black empowerment or black women-led companies. Then we write that into the mandate. And obviously we won't write a requirement into a mandate which we don't think is doable from experience, because then once again we're going to frustrate that investor. And by promising, yes, we can build your portfolio with these sort of requirements, not knowing that it's possible. So it's a fine line there, and that's why the communication and the understanding between the mandates of investor and the team itself is critical in the beginning.
Awesome, thank you. So we've got another one following on with mandates. The question is, does our mandate allow lending into African companies only, or do we perhaps look at SADC countries?
We can once again, SADC we've got experience in Africa. SADC is even more is a little bit easier. We'll sit down with the client. We have done such investments. If that's a requirement of the client, we will engage. We'll build potential portfolios out and present it. And yes, there's no reason why it can't be done, because as we know, the illiquidity from a borrower's point in those countries where they are underserved by the banks are even more severe than in South Africa. We see a lot, especially our colleague Werner, that travels across the world, but also in Africa, we see a lot of good transactions out of Namibia. We see good transactions out of Botswana, and a little bit higher. The challenge there sometimes is scale. It's small economies, illiquidity. Remember now, define exit. I said, you've got to bring the philosophy also into the conversation. And your probability of defaults and all that. So it's a broad conversation. The short answer is definitely yes. We can design a portfolio like that, or to have exposure to those markets. But it's a very broader conversation.
Thanks, Monet. Next question, why are South African retirement funds increasingly considering private credit as an asset class?
For the reasons we discussed, in any if you look at portfolio management, in its essence, you need diversification. If you then take a step back and you say, okay, well, I want to, as an allocator, I want exposure to credit. Well, your first point of reference is going to be public credit in South Africa. And you are going to be disappointed, or you should be disappointed. That's my opinion. Allow me to have that. Given the conversation we had the last hour about we don't really get compensated for risk-adjusted returns. Private credit offers you that. Just as we always, or like we claim, we do bespoke lending to the borrower because we have the time and the expertise to do that. The same we can do for the allocator. We can do bespoke mandates to the allocator. We can really ensure that he gets real diversification. Once again, it's me. I don't believe you get diversification in the South African public market. Not at all. But that's a different conversation. But I say that from real experience. It's not an assessment from the side. I've managed those portfolios. But all that we can do, uncorrelated, yield enhancement, low volatility, floating rates, that all we can do in private credit because we sort of manage, it's active management. So yes, I don't want to sell here, but I mean, for me, it's the greatest proposition in credit, and that's why we are so passionate about it, because we can really provide a pension fund credit exposure that's meaningful for all the reasons I've said the last 2 minutes. I don't know, Wim, if you want to elaborate on that.
Yeah, maybe just bringing it back to the pension fund and the pension fund portfolio manager. Obviously, their goal is to construct or build the most efficient portfolio on a risk-adjusted basis, and this is where adding that slice or allocating that portion to private credit really enhances their risk-adjusted returns on their portfolio due to the uncorrelated nature of your returns, the yield pick up, and then obviously the diversification benefits.
I see we've got some time left, Marlene. Maybe just to elaborate on the answer and on the question. What we've done before is and I must just caution myself. I don't want to throw public credit out of the window. All I'm saying is you got to have both. I can't see how you can just have public. That I can't see. And we've run hybrid portfolios before where we have one investor that have a quantum or certain exposure to public credit in South Africa, but then you fill it up with that alpha portion of private credit. And that hybrid return is also a very good product in my eyes, where if you get your weighting right between the two, I would say it's also a good strategy for allocator on the credit side.
Awesome, thanks all. Next question, what risks should retirement funds be aware of when allocating to private credit?
Good question. All the risks we mentioned. First thing is ensure that the team is really experienced. It's a very active, very you've seen from what we've said the last hour, it's a very active hands-on portfolio. So you need to, if I'm an allocator and I'm a pension fund sitting on the pension fund side today, you've got to make sure that the team really understand this niche market. It's a niche market because it seems to be small, but we saw the figures, we saw where the world is going. We spoke about the banks. It doesn't need to be niche because at the end it's still a bilateral loan. And we've all grown up with loans through various formats through the bank. Either you go to the bank for your car loan, you go to the bank for your home loan, you go to the bank for your business loan. It's a loan. So it doesn't need to be niche. But to come back to, you've got to have a team that really understand what is a loan And that's why I broke it down to its essence right in the beginning when I said, this is just a sophisticated way of a loan you would give to your brother that's got a problem, or to your cousin or to family member. Usually the people you don't want to give it to, and your first question, oh hell, is he going to pay me back or not? You know, that risk assessment. So it's critical that the team, and then the sub layers is, does this team expose its investors to the best potential transactions in the market out there? Meaning, most originators, if not all, know they are a very good team and they will be good to their client as the originator, and it will be a great experience for their client, which is the borrower, making sure the best transactions are on our table. So it's a team, originate good transactions, and then is the risk management. You know, our ability to assess risk very well, and we speak a lot about perceived risk and real risk. Perceived risk is just your buyer's quick assessment. No, I don't like the transaction. That's not what we do. We look past the perceived risk and we look at the real risk. And that's also, I think, a great advantage that a good team have, to really assess the real risk in this transaction and then to price it. So I don't want to repeat everything because I won't stop, but as per the slides we showed, all those things move into a complete proposition for as an allocation to a specific private credit team of your choice. But what I said, I believe, are the most critical as an enter into the sphere of private credit.
So if I can maybe just tag onto that, Marlene, where it's important here from a retirement fund perspective to do that proper due diligence on the team, and during that process, you know, as a retirement fund, you are able to identify all those aspects that Morne mentioned. You know, is the team properly qualified? Have they specifically got experience in, you know, this segment that you may want to allocate into? So that deep dive into the team is very important, and that will all be, you know, all the risks that you may as a fund identify will be overcome with that rigorous due diligence that you perform.
And Jimna, to add on to that, I see we've got time. You know, look at the investment philosophy and process of that team, because that's the day to day. You know, what is the investment process? What does it entail? To what do they do in each one of those components of the investment? Is it rigorous? Is it not? Do they adhere to what they promise at the front as a team? You know, is the communication, is the reporting as good as they promise it to be? Is the communication as regular as they promise it to be? You know, what's the quality of the reporting? So it's all those things add up to your experience as an allocator or as a pension fund allocator.
Thank you. So next question, given that obviously technology is evolving in its nature and it's playing quite I want to say, a pertinent role in especially our industry, how can it enhance the participation of retirement funds in the private credit market?
Technology, we see it from enhancing our own proposition by automating various processes that took a lot of time and effort previously, that we can now automate through the integration of clever ways of data and data points. So we speak a lot about technology from our own perspective in our product offering, in making us as an investment team or as a private credit team more efficient. And once again, either through risk assessment, through modeling, or gathering portfolio information, automate the gathering of the information, and then pushing that out into a format, like I said previously, or just now, back to the pension fund allocator and giving him the report, benchmarking, pricing. Those are all ways or all segments where technology is playing a massive role in our lives. Hence why we have our own data scientist in our team, and that data scientist person then takes us into the rest of the world. But you can't go as a portfolio manager straight into all these automated solutions. We believe you've got to have an in-house person that can manage that process. So I don't know if Wim or Yuma, if you want to add to that, but to be honest, we think a lot about technology from our own perspective, improving ourselves, than from the allocator point of view, by just providing a better value proposition to him.
So
No,
yeah,
thanks,
I can
Will.
maybe just
Yeah, go. Yumna.
sorry. Okay. So yeah, so just on that, from an internal perspective on how we see technology, yes, as Mona mentioned, it's extremely important. It's so important that we've got that in-house person, because we feel that every step within your credit process requires that automation, and by internally adopting those processes, the end result is beneficial to your retirement fund or allocators, because the information that you're able to provide is more streamlined, it's more up to date. Funders are able to see where, or have the opportunity to invest in various sectors, or specific, and get a report at the end of the day showing that they've not necessarily invested in one specific area, and they're able to achieve the diversification that they initially anticipated on initial allocation. So that's where we try and build, or we constantly try and make sure that we stay ahead of the curve, in the sense that we adopt automation, but we don't just leave it hanging. We constantly looking out and at new things, new providers, to enhance that offering from our side, which ultimately benefits your allocator in the back end.
Do you want to add to that?
Yumna took all the words out of my mouth, but maybe just from practical perspective, 10 years ago, us as analysts would have needed to sit and to receive PDFs of financial statements of companies, whereas now everything is built into our BACS Centrum, so we can just really look at the data. So the efficiency from our side is much more, it's much better, it's much more, and that gets transferred in terms of how we report back to the retirement fund.
Awesome. Thanks, guys. I think that was, that's very informative. So now the next question, it relates to how, I want to say, we provide capital, right? The question relates to, do we always request security when we are providing capital? And how do we protect the client's money?
Protect the investor's money. Yes. We always, like I explained, we always do asset-backed lending. Remember, also security can come in different formats. Most of the time it's tangible. But there's other ways too. We can create a defined exit through a warranty or a pledge from a third party to step in. We can have we call it credit enhancement. Just for practical ways, so we had a potential, we had almost a default, not because of default, it's just we wanted to end the relationship, because otherwise we would be acting like a bank, in the sense that the loan will go into perpetuity. So the client was servicing the loan on time, on the frequency it had to, but we wanted to end that relationship. Well, not we wanted to. The duration, the legal agreement stipulated that the loan mature on a certain date. The company thought that they would be able to to take us out through refinance from another financial option. That did not materialize. But we foreseen that, and before we did the transaction, we did we took out a credit enhancement policy for that, and that insurance policy stepped in, and we got all our capital and our interest back. And they went on with that loan and refinanced it over the next 6 months and all that. But we got out. So what I'm trying to say, there is ways where it's not always property or it's not all that, but there's clever ways that we can take or make use of, where we make sure that there is a collateral behind every transaction, which is core of our credit philosophy within 27.4, and should be, I would say, in any product house.
Thanks, Morné. So I see we've got a few minutes left, so I'm just going to then give you guys about 2 or 3 more questions. The next question is, beyond the definition of private credit, how does its illiquid nature impact its risk-return profile compared to traditional fixed income investments?
Good question once again. That's why we call it the illiquid premium. 2 things there. What we as on a portfolio management level try to achieve. Look, the illiquidity is there, so we're not going to try and hide it or push it away or sweep it under the carpet. The illiquidity can be there. But if you've got a specific liquidity profile that you want, we can do it. We in private credit can buy up to 90 days trade finance instruments on a very good yield. So we can go from 90 days to 10 years, or infrastructure. You can go, we don't have infrastructure specific strategy, but you can go to 20 years, 30 years on some of these infrastructure transactions, dams, roads, and so forth. But we can go from 90 days up to there. So but ideally, you want a balanced portfolio, and that's why I said, from experience, we aim to average about 18 months is a well constructed portfolio. So that illiquidity is there, and that's, once again, if I may repeat that, that's why I said I wouldn't put the bond market out of the way as a credit. I wouldn't put public credit out of that, although there's also not a secondary market at all. People think there's a secondary market, but it's not as efficient as it should be. But that's why also private credit is seen as a builder. And if you would look at your portfolio and on a liquidity profile, we are the first to say put it at the bottom, and don't see it as your most liquid asset. That it's not cash. Speak to the portfolio manager and get the profile you want, either 6 months or not, from 90 days to wherever you want to go. Let that be in the mandate, and make sure that they adhere to that, whatever your requirements is. But then also remember, then you've got subsectors of liquidity and illiquidity. Is you get regular coupon payments. All our transactions, we don't like to do transactions where there's not coupon payments. So you either have monthly, quarterly, or maybe biannual payments. We don't like to roll up loans. It's just part of our philosophy. So yes, you get your coupon payments that can be distributed back to the allocator too. Then after the first year, you start getting your maturities. So what I'm trying to say, on a rolling basis, let's say you've got an average of a year to 18 months transactions that you're busy piling on into the portfolio. So between your coupon payments and your maturities, your new transactions, you should have a quite healthy liquidity profile in that portfolio. And through those mechanisms, we can enhance the illiquidity aspect that you experience in private credit.
Awesome. Thanks, Monet. Then the next question is, and this was relating actually to your presentation, it was actually a beautiful graph that you had shown with the financial crisis and obviously how private credit has evolved. But it's with regards to whether we could elaborate on how post-2008 regulations like Basel III specifically drove private credit growth.
I think Yumna spoke about that, but so I'm happy to re-emphasize that because why I'm also passionate about that, but where it's easy for me to speak about, because I was lucky enough to be in the banking sector then, and then leaving the banking sector and experiencing that retraction of the banks, of where, and I think private equity too. I think those who in the know understand that the banks were playing in private equity and all that had to move off the balance sheet and all that. So you could see that retraction in the market on Basel III, and Yumna explained very well how Basel III is now turning into Basel IV, and she explained what the changes are going to be on the weighted average, weighted asset risk profile and all that. And so that all makes it difficult for the banks to really go willy-nilly and try and service the whole market, the economy out there. So they've become very, very specific, and we experience that on a daily basis on the times that we compete with them. As I also said earlier in the presentation, the first thing, just out of interest, we asked the counterparts, okay, Mr. CEO, how long have you spoken to your bank about this growth finance you're looking for to enhance the performance of your company? And the answer is never less than 6 months. So how can you make a decision if your bank is not coming back to you for whatever reason? And that's where we step in as private credit. We step in and we see if we can design a bespoke solution through a loan to that company, but that's acceptable to the company, that will enhance their position, but also acceptable to us on behalf of our investors, making sure that our capital is protected at all costs. So that's how Basel III and the financial crisis, from a South African point of view, enhanced private credit drastically. Can't speak for the rest of the world, but we see the figures there too. And I think now we'll start seeing if there's even a bigger sort of backward step from the banks that on Basel IV. Yeah.
Yeah, and with its implementation being 1 July, that is basically around the corner, we'll soon be able to see how that has a ripple effect on, the transactions that, come across our desks. It's an interesting exercise because, before Basel IV, banks were stepping away and there was this contraction. But now with the stricter capital holding requirements, it can only be a benefit to the private credit market.
Awesome. Thank you, Yumna, Monet. All right. I think that brings us then to the end of our webinar. I'd like to thank again the panelists for their informative presentation, as well as the audience for being so engaging. I think it was a very good presentation. If there are any further questions, you are more than welcome to email us at info@274.com, and then we can continue the conversation. That's a wrap. Thank you, Batsita, for organizing, and then we'll see everybody again soon. Keep well, everyone.